All right, today we're going to talk about asset classes by risk category. We will start from the lowest risk and then go to the highest risk. The first and lowest risk asset class is cash and cash equivalents. Investors typically hold cash as a way of maintaining liquidity. Cash equivalents include money in your checking account, but it also includes cash equivalents that are considered very safe, like treasury bills and commercial paper. Cash equivalents are considered low yield compared to other investments, but is great to have in case a good deal becomes available. There's little risk when it comes to holding cash outside of losing purchasing power due to inflation. Our next asset class we're going to talk about is fixed income, also known as bonds. These investments are exactly what they sound like. They make fixed payments on a principal investment with the principal returned at a specific future date. The most common fixed income investments are bonds, but bonds aren't the only type. For example, CDs or certificates of deposits are also considered fixed income. As the name implies, the yield on fixed income assets is fixed. You can generally predict exactly what you're going to get back in return when you first invest, but typically will make more than that. The company or government issuing a bond could default and fail to repay the loan. Treasury bonds are considered a safer form of debt since the US government backs them. Investments in fixed income securities are subject to various risks, including changes in interest rates, credit quality, market valuations, liquidity, prepayments, early redemption, corporate events, tax ramifications, and other factors. Investments in fixed income securities typically decrease in value when interest rates rise. This risk is greater for longer-term bonds, and investments in lower-rated and non-rated bonds present a greater risk of loss than higher-rated securities. The next asset class of the risk scale are real assets. Real assets include real estate or commodities like oil, wheat, or gold. You can have many different types of real estate. Real estate such as single-family homes, office buildings, apartments, or industrial complexes, or own a real estate in the form of a fund known as a REIT or real estate investment trust. Making money in real estate is typically happening at the buy, but many investors will also hold properties to generate cash flow over time. Cash flow is a beautiful thing. The final asset class we will discuss today are equities, also known as stocks. Stocks are my personal favorite way to invest, and they're my personal favorite asset class. When you own stocks, you technically own shares in a company. You can receive returns from stocks in generally two ways: appreciation or dividends, and most investors receive both. It is possible for you to lose money in stocks, so make sure you follow the proper principles of diversification. But over time, stocks have been a wonderful place to invest. If you need help with creating your diversified portfolio, then we're happy to help you out. A diversified portfolio should include a mix of asset classes. Which asset classes you invest in should depend on your financial goals and level of risk you're willing to tolerate. So if you'd like help with your portfolio, you can schedule a complimentary consultation at keepitsimplefinancial.com/talk.